Coming up on the SBS On the Money Markets podcast, the Australian share market rises today. GDP growing at its fastest rate in 2 years. The Australian dollar at a 3-week high and small caps in focus. All of that and more next. Hello, everyone. Welcome to the SBS On the Money Markets podcast for this Wednesday, the 3rd of December, 2025. It's a day where the Australian share market rose. The S&P ASX 200 up 0.2% to 8,595. We'll have the details with Chen from VanEck in a few moments. But first, today's GDP figures from the ABS showed Australia's economy expanded by 0.4% in the quarter to be up 2.1% through the year. While that's a 2-year high, it's below the long-run average of around 2.75%. What's driving the economy at the moment, though, is private investment as more money is spent on building data centres to cope with the rise of AI, along with housing investment or construction and household spending. Most of that was on essentials, though, like health and electricity. To tell us more, I spoke with Stephen Halmarick, Chief Economist at Economists Unchained. Stephen, how would you describe the pace of growth in the economy at the moment? Because while it's less than expected, through the year, it's at a 2-year high.
Yes, you're right. The 0.4% for the September quarter was definitely weaker than generally expected. And the Australian Bureau of Statistics has said, 0.4% is about the average growth rate we've had post the pandemic. So, it's kind of average. But as you mentioned, the annual rate is now above 2%. So that's really good to see. But, that's well below the long run average for Australia. The long run average is closer to 2.75%. But about 2% annual growth at the moment is probably close to the potential for the economy right now.
Can you run us through what's driving it and perhaps at the same time what's detracting from it?
Yeah, so it was an interesting combination of growth. So we did see a pickup in private investment, which is good to see. Some of that was housing construction, so definitely very welcome. But also a pickup in what's called machinery and equipment investment, which is basically data centers. So we did see an acceleration of private sector investment in data centers, and that's good to see. But as the Australian Bureau of Statistics pointed out, most of the inputs into that investment is either imported or comes from inventories. So we saw private investment contribute positively to growth, but that was offset, if you like, by a rundown of inventories and an increase in imports. So they're counted as a negative to growth. But that data center investment is likely to be a feature of the economy, I think, for a few years to come. But on the private spending side, so household spending, we did see an increase of 0.5% on the quarter in household spending, but that was weaker than the previous quarter. So the June quarter was supported by things like end of financial year sales and the Easter period. So things slowed down in the September quarter, and in fact, the increase in household spending in the September quarter was all on essentials. So spending on discretionary items declined on the quarter. Spending on essentials, and people I think won't be surprised to hear that was included electricity and health spending was the main drivers of growth there.
When you look at the economy, is it fair to say that our economy now is perhaps smaller than where it was, I don't know, a year or two ago, if GDP per capita is flat?
Well, so GDP per capita was flat on the quarter, and GDP per capita has only risen 3 out of the last 11 quarters. But on an annual basis, GDP per capita is up slightly. I think it was up 0.4% year to September. So marginally higher, but quite disappointing to see GDP per capita really unchanged for the last couple of years.
What do these numbers say about productivity in Australia?
Well, it was very weak again. So GDP per hour worked, if you like, one of the main measures of productivity, was up just 0.2% for the quarter, so pretty soft, and up 0.8% for the year. So we certainly are not yet seeing any meaningful pickup in productivity growth. So GDP per capita, pretty flat. Productivity growth, pretty flat. That's not great. But overall, the economy is growing at about 2% per year. That's better than it's been for the last couple of years, but it's still pretty modest.
Okay, straight after this number came out, the Australian share market rose quite dramatically. What do you think it'll likely then mean for interest rates? What it'll mean for the RBA? Because we know that the RBA is obviously more focused on inflation and the jobs market.
Yeah. Well, certainly those most recent inflation numbers, including the new monthly number a week or so ago, were pretty bad. Definitely higher than the RBA and most economists, including myself, would have expected. So, had some people saying, maybe the RBA's got to turn to rate hikes next year. But I think this data just reinforces that although inflation's a bit higher than expected, the economy overall the growth rate's still pretty tepid. And, rate hikes, I don't think are on the agenda anytime soon. So it looks like we're now most likely in for quite an extended period of interest rates on hold where they are now. I think it'll take at least until May next year before the RBA's got enough information to say, is the inflation rate slowing down again, or is it staying too high above that target range? With economic growth pretty modest, and if we do see any softening in the labour market, we might see the inflation, the deceleration in inflation resume, and then the RBA could think about lowering interest rates again. But right now, I think rates on hold for an extended period.
It's Stephen Halmarick there from Economists Unchained. Let's take a look at the impact on the Australian share market now, where the S&P ASX 200 finished 0.2% stronger, 8,595. 8 of 11 sectors ended higher. Utilities, energy and property doing best. The worst performers, healthcare and industrials. The best performing stock today, Boss Energy, up by almost 7%, followed by Bellevue Gold and Paladin Energy. The worst performers, HMC Capital, down 5.5%. Buy now, pay later operator Block down by 6%, and Megaport off by 6%. For more on the day's market action, I spoke with Alice Chen, portfolio manager at VanEck. Firstly, how's the market reacting to today's GDP results and why?
Well, the market was disappointed with underwhelming GDP print today. We've only got 0.4% quarter-on-quarter compared to the consensus of 0.7%. But then the market sort of digested a bit more and now has recovered. I think this disappointment is warranted because the Australian economy has actually held up reasonably well this year, given the healthy GDP growth as well as the resilient retail sales growth. But so far, we are seeing the market ticking up again now.
Okay, so what do you think this means for interest rates? What's the market saying? Is the next move likely still to be down rather than up?
Well, I think a single data point won't necessarily lead us to a rate cut. Bear in mind that for October, inflation actually ticked up a bit higher. If we look at just the headline inflation as well as the trimmed inflation, it's still well ahead of 3%. And then there are also pretty sticky components of the inflation, such as services inflation, housing, and electricity. They have increased pretty remarkably over the past year or so. So it's really it's gonna be a tough nut to crack for the RBA, and I don't think we are going to cut rates anytime soon.
Okay, the Australian dollar, though, is at a 3-week high against the US, but how much of that has to do with things like the direction of US interest rates as opposed to ours?
Yeah, I think that's a good question. And recently, we have seen Australian dollar strengthen quite a bit against the US dollar. And we do tend to agree that this is more of a US story rather than the commodity prices movement or the economic outlook for China. If we look at the US, the market is now pricing in almost 100% rate cut of 25 basis points from the Fed meeting December. So this has sort of weakened the US dollar. If we look at the DXY index, which is a USD index against a basket of developed market currencies, they have also weakened. So this goes to show that the US dollar has weakened. And also, if we look at locally, the RBA, we think, is not going to cut any time soon, even though today's GDP print has underwhelmed. So this sort of divergence of the direction of travel between two central banks, between Australia and the US, has created a difference that caused the AUD to strengthen.
And finally, what are you telling your clients right now? Where do you see the opportunities for investors?
Yeah, I think it's quite an interesting space now for Australian small caps. We have been looking, and right now, Australian small caps has outperformed S&P 200 by over 13% now year to date. We think the improving economic conditions, such as the resilient GDP growth, as well as the retail sales growth, has really propelled the small caps to outperform the broad market. And if we look at the more cyclical sectors, such as consumer discretionary, as well as industrial sectors, they have also performed very, very strongly. And in addition to that, Australian gold miners and also critical mineral miners have also rallied. We do think there is further room to run in this space, but not all small cap stocks are equal. If we look at some of the more expensive growthy stocks, their valuation looks quite frothy to us, especially the likes of DroneShield as well as Megaport. We do acknowledge that the forward earnings growth expectations are improving for the small cap sector, but I think investors need to be prudent and probably using a GAP approach or the growth for reasonable price approach will be more prudent to capture the small cap stocks that has reasonable trading price compared to historical multiples, and then excluding the stocks that has been pretty expensive and prone to downside surprises.
That's Chen there from VanEck, and she wraps up the podcast for this Wednesday. Don't forget, if you enjoy it, give it a rating or review on Apple Podcasts and Spotify, and click subscribe. See you on Friday.
This SBS on the Money podcast is provided for informational purposes only and should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.